Michael, what do you make of today's drop? You know, it did look like we were stabilizing. In fact, the S&P futures were up this morning when I came into the office around 3 o'clock. They took a hard turn lower around 5, and it looked like it was the Russia-Ukraine news that drove us down. Was that the issue?
Certainly icing on some of the cake here, but look, I think Friday we had our first close on the S&P 500 below the 200-day moving average into a weekend. That's not a good sign, and you know, dip buyers, require a great deal of courage to be the first person to sort of buy into that Monday morning dip after a close like that on Friday here. But look, Matt, with all that being said, I think it's a few things to point out here. One of which is that the equity risk premium, and what that is just simply the inverse of the price earnings ratio based on forward bottoms up consensus estimates, not mine or it's just Bloomberg consensus estimates. That less the 10-year interest rate, the 10-year Treasury yield, is now at the richest level, meaning most attractive for equity, long equity positions that it's been in a year. Now, it's been more attractive, at periods before COVID and so forth. But it's important to recognize that every day, as you were just commenting, the 10-year yield gets a little bit lower, and the S&P price index and its brothers, the NDX and so forth, also go lower. That keeps upward pressure on that equity risk premium there. One thing that's not going lower is, at least so far, is that, forward earnings estimates are continuing to sort of slowly and quietly grind higher. And I think, if we learn through the season that the earnings story is actually not tragic, that it's actually going to be sort of what the markets have been anticipating, then the valuation case will be a bit more obvious.
This is why, Michael, this is why I have to question whether it's geopolitical risks, because yes, there was more talk of Fed rate rises, Goldman Sachs out saying the risks to more than 4 increases are higher, Bloomberg Economics saying you could see 50 basis points in March, but that was all pretty much baked in, wasn't it? I mean, we've been talking about 4 rate rises for at least a week now, and we've been talking about 50 basis points here and there every day last week. It seemed to me that the only thing new was there seems to be more concern that Russia will indeed invade Ukraine.
Yes, and look, a couple of comments here. First, and to your point that it's so much of this hawking rate hike narrative is there. It actually every time you hear a forecast of a lot of hikes, more so than the other person just said, that only makes Powell's job easier to deliver a sort of marginally dovish response, but still deliver some hikes, right? It allows him to thread that needle easily, which is, I would argue, risk asset supportive. As it relates to the Ukraine, my general sense here is that, look, I'm not going to opine on the probabilities of us going to, a more pronounced conflict there. But I would say this, if you remember back when Putin took over Crimea, the VIX moved from 14 to 14.7 or something for 3 hours and then gave it back there. So I think, to my mind, that these geopolitical tensions can just sort of really accelerate the broader trend downward here. Now, having said that, I would also suggest that this situation in Ukraine looks more problematic than Crimea did there. But I would just simply I look at it as sort of more of a magnifying condition, unless we really go to some decidedly more unpleasant and disturbing news events.
It doesn't make any sense that, my buddy Adam Johnson used to call these kind of corrections the pause that refreshes. And Peter Cheer says we had some decent capitulation today. Does that mean we could get a bounce from here? You talked about the dip buyers, and we seem to see them for a moment, but they haven't come back.
Look, I think we're pretty close. Certainly, just measuring it on the VIX curve, you're starting to see something that's looking like capitulation here. That doesn't mean we can't go higher on the VIX and further lower on the S&P 500, but I think we're pretty close here. And I think if you have been long index puts, to start thinking about managing those profits, and also, just from a pure tactical trading perspective, looking at some short-term calls here to play bounces here. That's not by the way, a view that like, oh yeah, like the bottom's in and it's only going to go to fresh highs again. I think this, this technical violation and this sort of reassessment of what's really going to happen with interest rates, what's really going to happen with inflation, that's going to take some time to process there. But again, I think ultimately this will be a pause. Your friend Adam Johnson's right. I think this will be a pause that refreshes. We've had a ridiculously strong equity rally in 2021 where, dips of 4% were considered violent. So we're overdue for some of this there. But I don't think that means that the buy equity case by any stretch is done there. But
what about rates? What about rates, Michael? I mean, I get your argument that the more rate rise notes we see, it could be 4, it could be more, it could be 50 basis points, gives the Fed a little bit more room to move. But what about buying bonds in a time like this? Econ 101 or Trading 101 would say if you expect the Fed to rise, you want to buy today's bonds because you're going to get a better coupon later. And yet people are piling in.
Yeah, well, there's a couple of things going on. Obviously, some risk off is driving that Treasury bid. But before January, you really saw, for really since last spring, sort of a range-bound back end, and all the violence in the bond market, all the excitement was on the front end of the curve there. And I think that really comes back to this sort of core discussion of what's going to happen with a long-term, the terminal rate and the long-term view of interest rates here. And I think that's the bond market is kind of like keeps triangulating that we're not going to really be too much higher than, sort of 1.6, 1.8, maybe 2% on Fed funds, out in 2025. And so as long as that condition holds, I don't see a reason why the 10-year has to explode higher here. Matt, I know you have a German-centric perspective on some things. The Bund yield was, really creeping higher here as well, and I think that was reinforcing something. I think that's an interesting security to keep an eye on here if that were to really change from being sort of that mildly negative condition to positive and possibly an ECB shift here. I think that would be an interesting thing that would help sort of reinforce a bearish 10-year Treasury condition on this side of the ocean there. But again, those things are still more, cases to consider than sort of base case plans right now.
What do you think about valuations? I mean, at the end of the session, we're looking at, or as we approach the end of the session, a PE on the S&P 500 of 23.4. We still have a dividend. Well, the trailing dividend rate is only 1.4%. Do valuations make sense to you here? Do we need to go lower?
No, well, look, I mean, I think we certainly can go lower just given the sort of this, the sort of like this, the velocity of the selling has been really striking here. But in terms of, look, if the 10-year is going to be anchored at, somewhere between 1.5 and 2% for the foreseeable future here, and the Fed can communicate that we're going to do some hikes, we're going to sort of catch up here, but we're not going into sort of a categorically hawkish view. In other words, that famous Powell comment from early October of 2018, we're far from neutral. If he kind of avoids that type of push here, then I think equities, you will start seeing dip buyers again here. I think if you had the view that the 10-year is going to be at 3% in 2 months, then you should not buy equities here. But I'm pretty constructive on Treasuries, and I'm also by extension, therefore, pretty constructive on risk assets like equities. And let's not forget that the big tech earnings have continued to sort of historically generate really strong growth, exceptional volatility adjusted earnings growth. And as the earnings season unfolds for the big tech, I think if they can reinforce that, I think that'll help sort of reinforce this concept.
Michael, you kicked off talking about earnings, and we've been following financial conditions for some time, waiting for the Fed rate rise talk to somehow move the needle there. And if you type FCON go on the Bloomberg terminal, you can see that we've come down considerably in the last few trading sessions in terms of financial conditions. What's your outlook for the U.S. economy right now?
Look, I think the at the end of the day, we're looking at nominal GDP. These are Bloomberg consensus estimates of 7 to 8%, which is really exceptional here. The balance of inflation to real growth in that nominal GDP story. Nominal GDP is what drives the earnings, the revenue, and the earnings, right? It's not real GDP. It's a combination of that. That if the nominal GDP is going to be that high, and the component of that is sort of is a reasonably healthy balance of inflation and real growth, and the margin compression story for the key parts of the index is managed, then I think you're going to see a very constructive earnings situation this year. And the following year, in 2023, I think I'd also make the point that, for all of these supply chain issues that have sort of exacerbated inflation, some of them are also pushing growth. They push growth from 21 into 22 and probably 22 into 23 there. And so, when COVID hit 2 years ago, we were all sort of like, oh my God, we're going to have this massive V, and then then that party's going to be over. And I think what you're seeing is that there's going to be sort of probably certainly a more extended floor at a higher level for economic growth than we've seen before. That doesn't mean there's not a lot of confusion and noise along the way.